Term versus whole life insurance. It's one of the most common questions people ask when they start shopping for life insurance, and it's easily one of the most misunderstood decisions in all of personal finance. So let's give you the short answer right up front. For most people, term life insurance is cheaper and makes far more sense, while whole life insurance only really pays off in a few specific situations. But stick with me, because the why behind that answer is where the real money is. Understanding this difference could genuinely be worth tens of thousands of dollars to you and your family over your lifetime. Here's the core problem. If you asked 5 different people which type of life insurance you should buy, you'd probably get 5 completely different answers. Your uncle swears by one, a coworker swears by the other, and some of the loudest advice comes from people who quietly earn a commission when you pick the more expensive option. It's genuinely confusing, and that confusion is expensive. So in this video, we're going to cut straight through all of it. No sales pitch, no jargon, no fine print, just a clear, honest breakdown of what each type of insurance actually does, what it really costs you, and exactly who each one is right for. By the end, you'll know precisely which one fits your situation. Let's start with the simpler of the two, term life insurance. And the good news is, term life is exactly what it sounds like. It's insurance that covers you for a specific term, meaning a set, agreed-upon period of time. Here's how it works. You choose how long you want the coverage to last, and the most common options are 10, 20, or 30 years. You then pay a fixed monthly premium, and that price is locked in for the entire length of the term. So if you lock in a rate at 30, you're paying that same rate at 45. Now, the important part, if you pass away during that term, your beneficiaries, that's your spouse, your children, or whoever you choose to name, receive the full payout, tax-free in most cases. That money is designed to step in and replace everything you would have provided. It can replace your lost income for years, pay off the remaining mortgage so your family keeps the house, cover everyday living expenses, or even fund your kids' education. But here's the part that trips people up. If you outlive the term, which statistically most people do, the policy simply expires. You don't get a payout, and you don't get a refund of the premiums you paid over the years. And I know that sounds like a downside, like you paid for nothing, but it's actually the entire reason term life insurance is so powerful and so affordable, because the insurance company is only taking on your risk for a limited, defined window of time. They can charge dramatically less. A healthy 30-year-old can often get several $100,000 of coverage for less than what they spend on streaming subscriptions every month. That is the core advantage of term life. The maximum possible protection for the lowest possible cost, exactly when your family needs it most. Now let's talk about the other option, whole life insurance. And as the name suggests, whole life insurance is built to cover you for your entire life, not just a set period of years. As long as you keep paying your premiums, the coverage never expires. Whether you pass away in 30 years or 60, the policy is still active, and your beneficiaries are guaranteed to receive a payout. That guarantee is a real, genuine benefit, and it's worth understanding. But here's where whole life gets more complicated, because it does something term life insurance simply doesn't. A portion of every single premium payment you make gets funneled into something called cash value. The easiest way to think about cash value is like a savings or investment account that's built directly into your insurance policy. Every month, a little bit goes in, and over the years, that cash value account grows. And it gets more interesting, because that money isn't locked away forever. While you're still alive, you can actually borrow against that cash value. Need money for an emergency, a down payment, or a big purchase? You can tap into it. So when you lay it all out, whole life insurance sounds like the obvious winner, doesn't it? You get lifetime coverage that never expires, a guaranteed payout no matter when you die, and a built-in savings account you can borrow from. If it's loaded with all these benefits, why on earth doesn't everyone just buy whole life insurance and call it a day? Well, that's exactly where the catch hides, and it all comes down to one thing: cost. Here's the single number that changes this entire conversation. Whole life insurance typically costs somewhere between 5 and 15 times more than term life insurance for the exact same amount of coverage. I want you to really sit with that for a second, because it's easy to gloss over. 5 to 15 times more. Let's put actual numbers on it, because that makes it real. Imagine 2 people both want a $500,000 death benefit. The person buying term life might pay around $30 a month. The person buying whole life, for that same $500,000 in coverage could easily pay $300 or $400 a month. Same payout, wildly different price. And it gets even more important when you look at where all that extra money is actually going, especially in the beginning. In the early years of a whole life policy, that cash value we talked about grows painfully, frustratingly, slowly, because a large chunk of your first 2 or 3 years of premiums doesn't go into your savings at all. Instead, it goes toward administrative fees and, crucially, the commission for the agent who sold you the policy. It can genuinely take 10 years or more before that cash value grows into anything you'd actually call impressive. So here's the shift I want you to make. The real question was never simply which type is better. That's the wrong question, and it's the one that leads people to overpay. The right question, the one that actually saves you money, is this: what am I really trying to accomplish here? Once you answer that, the correct choice becomes obvious. So let's get practical and answer that question. Who is term life insurance actually best for? Term life makes the most sense when you have a major financial responsibility that has a clear end date, and when you stop and think about it, almost all of life's biggest financial obligations do have end dates. Take a mortgage. If you have 25 years left on your home loan, you need coverage for those 25 years. After that, the house is paid off and that specific risk is gone. Or think about raising children. Your kids are financially dependent on you for maybe 18 or 20 years, and then they grow up, get jobs, and support themselves. In both of these very common cases, there's a clear window of time where, if something happened to you, your family would be in serious financial trouble. But once that window closes, the mortgage is paid, the kids are grown, they simply don't need the insurance payout anymore. That is the exact scenario term life insurance was designed for, and this is precisely why most fee-only financial advisors recommend term life for the average person. And I want to emphasize that phrase, fee-only, because it matters. Those are the advisors who charge a flat fee and don't earn a commission from selling you insurance products, which means their advice isn't tilted by what pays them the most. Overwhelmingly, they point people toward term. You get the most protection for your money during the exact years your family actually needs that safety net. Now, does all of this mean whole life insurance is a scam or a ripoff? Absolutely not, and I want to be fair here. Whole life is a completely legitimate financial product. It's just built for a much narrower set of situations than the people selling it often suggest. So let's talk about when whole life insurance genuinely is the right call. The first case is when you have a permanent dependent. Picture a parent with a child who has a lifelong disability, someone who will need financial support for their entire life, not just until they turn 18. In that situation, coverage that never expires isn't a luxury. It's exactly the right tool. The second case is estate planning. For wealthier families, a guaranteed whole life payout can be used to cover estate taxes, which means the heirs aren't forced to quickly sell off a family business or property just to pay a tax bill. And the third case is for high-income earners who have already maxed out every other tax-advantaged account they have, their 401k, their IRA, everything, and are simply looking for another place to put money that grows with some tax advantages. Now, do you notice the pattern running through all three of those situations? They're specific, they're relatively uncommon, and they almost always involve either a genuinely permanent need or a significant amount of wealth. What they are not is the default situation for the average person walking in to buy their very first life insurance policy. So let's bring it all together simply. Term life insurance is the affordable, sensible choice for the vast majority of people who need protection for a set number of years, covering the mortgage, raising a family, and replacing their income during their working years. Whole life insurance, by contrast, is a specialized tool that fits specific long-term needs, like a permanent dependent, estate planning, or advanced tax strategy, once everything else is maxed out. The single best way to decide between them is to figure out the exact financial gap you're trying to protect, and for how long you need to protect it. If that gap has an end date, term life is almost always the smarter, cheaper choice. Subscribe so you don't miss it, and I'll see you in the next one.